Welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Craig Cecilio. And Craig is the founder and CEO of DiversyFund. DiversyFund imagines a world where everyone can invest and build wealth, equal opportunity into all kinds of investment, including, of course, real estate investment. His mission is to break down the barriers keep most Americans from investing in real estate, something that is currently has been kind of left and protected only for the privileged, the well-connected, and the wealthiest 1% in the country. So, Craig, welcome to the show.
Thanks, Eric. Thanks for having me. Appreciate it.
Yeah. So tell us a little bit more about your fund, DiversyFund. For my understanding, it is a REIT, a real estate investment trust. It's public, it's registered, but it's not traded like some other REITs that you see on the stock market right now.
Yeah, it's a private fund, so it's private markets, but it's publicly registered. We have to get SEC qualified to offer this. Of course, when you start offering investments to the consumer or the everyday investor, I like to call them, there's a higher level of scrutiny through the regulators, and so they want you to get qualified. This came out of the Jobs Act in 2012. I believe the first one offering got approved sometime in 16. Even though they passed the regulations in 2012, it didn't allow people to use the Reg A Plus offering until I think it was July of 2015. Yeah, the quick turnaround. Passed law in 12, not until 3 years later it gets and then the first ones to start using this and filing this stuff, I think the first one went live somewhere in 16, because of course everyone you have to hire attorneys to do this, and the first movers take a little bit longer to get these things going. And we had our first one activated in late 18, I like to say January 1st, 2019. And we started lowering the minimums to $500 in June of 19. And around July of 19, this whole process was done through our online platform. It's mobile friendly as well. Today we have an app, so there's no people in the whole process. The whole thing's using technology and product, and it's all in the digital space. So it's been quite a journey to get to where we are today.
Yeah, so exactly. I mean, I think part of it is that Jobs Act was instrumental in kind of opening up a lot of these investments to what we'd call the retail investor, the other 99% that don't have normally access to these kinds of real estate investment, real estate project. So obviously, before the Jobs Act, you would just do a syndication, and it would allow some accredited investors, people that were sophisticated enough and had, enough funds to basically invest in these syndication. It was higher risk and all of that. But the Jobs Act really opened up, kind of democratized the investment and real estate investment world to non-accredited investor by providing some filings and transparency to the investor. And also that's when the crowdfunding also that opens up the crowdfunding situation as part of that kind of like that act, and then the following acts after that. So I think people have heard quite a bit about the syndication. So how do they compare? How does a REIT compare to a syndication?
That's a great question. I started out early, or in the late 90s, I started syndicating my first deals. So I'm quite familiar with syndication. I've done that a lot with institutions and high net worths over the years. And what we did is we had to create a vehicle that we thought would be great for the everyday investor, since we have minimum so low. And we created a fund. In our fund, we created a REIT with that, just a real estate investment trust with that. So it's more for tax purposes and more so people could benefit from that specific type of tool to use, a REIT versus a fund. And to do that, to go through that whole process, of course, you have to get that qualified through the SEC. You have to submit it there, and they have to, the word's qualified. I want to use the correct word here. They have to qualify it. There's all these different words, and you don't think that they're important, but in their eyes, it's very important to say the right words. I'm qualified in using the right word. Don't misquote me. At times I feel like Elon Musk. If I say something wrong, they don't like me, the regulators. And that just provides, and basically at the end of the day, with a REIT structure is you can't really retain the profits. You have to disperse them to everybody. So over 90% of the funds that come to it have to be dispersed, and you get 1099 at the end of the day, not a K1. So if you don't know what that is, talk to your accountant. They know, and each person has their own type of circumstances if that works for them or not as well.
Yeah, exactly. So and we're not going to talk about that, but yeah, there's a big difference between the 1099 and the Schedule K or K1 that you get normally if you're in a syndication or in a joint venture, for example. Definitely talk to your accountant for the details, but they're taxed very differently, and also the pass-throughs happens with the Schedule K, and they don't happen necessarily on the 1099. The other thing too is that 90%. Basically, you have to disperse 90% of your profit at the end of the year. So how does that impact your growth or your ability to kind of like reinvest the money? Do you have any impact associated with that?
Not with our business plan. We're consistently have offerings going all the time. So we're consistently raising capital all the time. We have hundreds of thousands of transactions happening a month right now. Our community is over 30,000 people have invested. We're over 500,000 accounts sign up, with that continuing to increase month over month. So we're at that point in time where we've made it, we got there, so it doesn't affect us. Of course, in your early days of building this out, everything's kind of a little nuts, and how do you do it? We got, you want to say, you can't say how great DiversyFund did. I want to take credit for it. We bought during the pandemic, and everything kind of took off and appreciated no matter what you did. So we benefited from that as well. I can't say that's just us, but timing does make a difference of us building this platform out at a point in time where we had this massive amount of appreciation. And here we are today with massive amounts of inflation going on due to that. But that's a whole other conversation.
Yeah, exactly. So I think a lot of our listeners, they're really interested in kind of like people's journey, kind of like how do you get to where you are today, and and then it's very important to see the kind of like how did you go from where you were in the past, the kind of education you had, and what made you choose to go into real estate, and how to invest in real estate in that particular way with DiversyFund and using a public REIT.
It's a life journey for myself, I would say. And I always have to remind myself what gets me up in the morning each and every day. It's not about making money for me. It's about my passion is more about building something for people. And that's what gets me out of bed every day. And I had to really dig deep into that. And I had to ask myself, well, why? Why do I do this? It is quite an undertaking, because being at my age and I could just do a regular fund, I probably make 10 times as much money. So it's definitely not the money. And it goes back to childhood. It's seeing my parents, my father struggling. It was more of a working class family. My mom was a school teacher. My mom ended up being the breadwinner. Grew up in a fairly affluent area of Fairfield County in Connecticut. If you don't know about that, that's basically Connecticut's a suburb of New York City, basically. I could drive through the whole state and get there quicker than I could go from San Diego to LA, which is now like a 5-hour journey, it seems. And anyway, that being said, and I was always on that path. So that was the fire. And so as my journey brought me out to California, and I always felt like I read about building wealth was always through real estate. So in the late 90s, I got involved with that, learned how to syndicate, learned how to get deals, learned how to structure deals and do all that stuff. And during that time period, I was serving a lot of institutions and accredited investors, and I saw how well they did. And at the same time, I saw how greedy they were. And so that actually built a little fire in myself as well. There was never any gratification for helping them out. It was more like, how much can I make? How much more I can make? It's all about me. We don't know whatever deal we're doing. They always had these great terms for themselves. So I was like, this is not win-win. And I always looked at things in life. It has to be win for everybody. Has to be a win for the investors, has to be a win for if you're working with other sponsors, you have to be a win for yourself. And how do you create something? So when I saw the Jobs Act and happen in 2012, which was a great time period, because that's when technology was really kind of evolving. And at the same time, the timing with social media taken off too, because that really kind of started kicking off out of the Great Recession. all those pieces kind of came together, and I had one of those aha moments, like a light bulb went on. This is what I meant to do. This is the skill set I have. Here's the fire, and here's all these pieces coming together: digital age, the right regulations coming through, the right product, and putting all those pieces together. And that's when I set out and said, hey, I got to build this company out. And that's when kind of the genesis of DiversyFund was forming.
Yeah, I think it makes perfect sense. I mean, I don't want to. I have a similar journey as well, and I know that the regular, like the working class and the middle class, they're underserved. The middle class is just being squeezed to the bottom. And you know, I don't want to plug my company here, but I will. Martel Turnkey. I mean, this is one of the reasons why we started the company, and we're helping investors or new investors, people that don't even think about investing in real estate, to start building a passive income portfolio to, you know, to basically achieve financial freedom, retire, and maybe retire comfortably, retire a little bit early maybe, and also build multi-generational wealth. So I think these things are very important to me and to my family. And this is why we're doing this. This is why I'm doing Break Away from the Rat Race. This is why, you know, I wrote my book and all that kind of stuff. So I think from that perspective, I think we're very, very much in line, I think, with our goals. And, you know, the accredited investors and the, you know, the 1%, I mean, they know how to fend for themselves. They don't need our help. But the rest of the population, the 99%, this is who needs our help in order to, otherwise we're going to have a major crisis in our hands if we don't help them out. That's kind of my belief.
Yeah, and during times of uncertainty and times and downtime periods, you always see this great transference of wealth. We just came out of a pandemic, and looking back, who benefited from it?
Yeah.
And before it, we had a pretty wide gap. Now it's even wider, and it's amazing. And history just repeats itself again and again. So we're trying to democratize the process, and there's a ton of obstacles in the way. You got the regulatory agencies leading with regulations and not leading with education. I think there's a big difference. Being a sophisticated investor, to me, that's a how do you say, a code word saying you are privileged, you're sophisticated, you're smarter. We live in a digital age. You could access any information online. You have the ability to self-educate yourself today. So we have to match that with the regulatory agencies and have some type of compromise there, so we can allow people the access to these things, especially private markets. This is where tons of wealth is made in the private markets, and they're so opaque. And most people don't know about it. They're not taught about this in school. You usually learn about this later on in life when you're 40 or 50. Maybe that's when you become an accredited investor, right? Later on in life. What about in your 20s?
Lucky.
Yeah. And why can't you start going? And with all these great tools out there today with technology, you can start building wealth at an early age. And it kind of, God, I sound like my parents. The habit of saving, right? But with the tools, it's like we have a tool. It's an auto invest option. People come and they sign up, and they have money coming out of their bank account on a monthly basis. And tools like that helps us. You get in the habit of saving, a habit of building and saving wealth over time, and just understanding just a little bit at a time, and that just compound years at a time. And if you start that when you're 45, 50 doing that, you're not going to build it up. But if you can start that in your 20s and 30s, when you're 40 and 50, you have a substantial nest egg already built up. So it's kind of mixing everything together. The new rules, as well as the technologies, and some of these traditional opaque businesses out there, and really giving people access to them, giving them the opportunity to start participating.
Yeah. So, and I think this is true. I think now we have, in terms of education, I think there's still a lot of work that needs to be done in terms of education and having people think about how to invest and all of that. And I think there's a lot of noise that Wall Street, they call it marketing, but Wall Street is putting out there about kind of investing in the stock market as if that was the only option possible, and save so that we can get our fees and and the opacity that you mentioned. I mean, they seem like they are publishing information, but they're using lingo and language and code words that not many people understand. And then they invest in those things thinking, oh, this is safe and secure and blah, blah, blah. And so I think that there's still a lot of work like on the education side, I would think. And then there's the what I would call what we're doing, the real estate investment and the REITs is like kind of, it's weird to say this, but it's kind of an alternative investment. But stock market should be the alternative. But you know, we're considered the alternative investment because we're not really part of Wall Street, and we have a different path on that. So this is why I think you coming on the show, I think it's great. It's a great way for us to spend some time and educate people out there that, you know, you exist. DiversyFund is a different way, an alternative way to invest. It's public. It's they have a lot of information. You publish a lot of information about what you're doing, and this is the kind of like the importance of that. Yeah.
I just feel fortunate to have this opportunity to give back by creating something like this. I find it's been quite a journey to build this up, and by going through that process, it's great that we've done it. However, I also get a little concerned is other people entering the space. It's a tough space to enter. It's expensive space to enter. And I like, you like to have competition because it really breeds you to be better and produce a better product. Yeah. But we really don't have too much competition because the barrier to entry to start this business is so high and the costs are so high. You look at things and how the system's set up, and hey, if you want to wire some money, if you were wiring $1 million, it costs you the same as someone wiring $100. But then you say, let's say your wire fee is $10. $10 is nothing on $1 million, but $10 on 100 is 10%. And so who gets hit? Who suffers from that stuff?
And actually, if you have $1 million in the bank, most of the time I don't pay wire fees because you get to a certain limit, and then they just, oh yeah, you don't have to pay fees. So,
but everyone who's got $100 or $1,000 or $10,000 gets hit up. So it's not a level playing field with the just how the inner workings work. Yeah, the cogs in the machine.
Yeah. So information and education, I think this is very good element, and I think, you know, hopefully about all the YouTube, the social media, and all of that, I think people have much more access to information, and they can also, with your platform, when they go on DiversyFund, they can see information about about your fund, what you're doing, the projects that you're doing, and kind of like what to expect, right?
Yeah,
you have a lot of information that you provide them.
We do. There's a lot of information we provide. The assets that we're in today, they're about $15 to $25 million average purchase price. Those assets, those are things that really you have to be have a rather large amount of money to participate in those. So now, hey, I have $500, $1,000, $10,000, even $25,000, and you get to participate in an institutional quality investment is something that I think is great for people to have that opportunity for the first time now. And it's been great. It's been a great time period for doing this, and really educating the people about everything from soup to nuts. We're finding out with a lot of our feedback is we have to educate them across the board with everything is how much they should invest, a little bit about the product itself, how that works. Some things are amazing. There's always human nature. I always like to talk about the difference between growth and spec. There's a big difference there. Yeah. A lot of people really educating them about that. Liquidity standards for themselves, the diversification of their own portfolio is, since we have low limits, you don't put all your eggs in one basket. So what percentage of your own portfolio do you want to put in this? And I think this is really where our platform helps people out, is they could look into it and look at from personalized point of view and saying, hey, maybe my net worth is $25,000 and the max I'm going to stick in this is $2,500. And really, so they could diversify where they are at that point in time in their life. And so this really opens the doors for someone and you can go as young as 18 and to as old as 65 is usually the standards there. So wherever you are on that spectrum, you personalize your approach to investing. So a lot of things there.
Yeah, absolutely. Yeah, so I want to go back to competition. You mentioned you had no competition. We're going to change that. I want to tell you, we're actually creating in next this like the end of well next month. We're going to launch a digital, like a tokenized real estate fund that's going to invest in single family rentals. So that's one of the things that that we're working on right now, and people are going to be able to invest as little as $50 a month. So that's going to give you, it's a little bit different space than what you're doing, but at least it's going to be a little different. All the shares of the fund are going to be stored in a digital wallet, and then we're also going to distribute cash flow to the funds using a stable coin. So that's kind of our plan there. So we're trying something different, the same way that when you started this fund, the REIT fund, you tried something new to basically democratize investment. We're trying to do the same using the blockchain technology and all that. So that's going to help you, and then hopefully we can come back, maybe 6 months or a year from now and see kind of how things evolved and learn from one another from our experiences.
Yeah, love to share you the tech stacks of what you guys are putting together behind the scenes, because that's one of the things we've been working on the last couple of years, is really improving that process with all the little working with the regulatory agencies and all those little costs that are involved with that. I love the blockchain because that really takes away a lot of some of those players in that space.
Yeah.
There is a lot of navigation with doing that stuff. It's not simple, which is unfortunate. But however, I think things are starting to open up and people are starting to accept that the new technologies and the blockchain and the currencies, and we'll see how that develops over the years. It is an undertaking, but it's definitely something that, like I say, is we could use our superpowers for good. If we could do it in a good manner, we should be able to use it as a society. I think we're always looking at sometimes we're looking at the bad actors, but we got to take a different approach, the educational approach.
Exactly.
How does this help people out, not hurt them out?
Exactly.
And the more people who do that, and I think we need not to have one company or two companies succeed. You always hear Apple, Google, Facebook. And then now you got what's it called? Twitter and Tesla together.
Twizzler, yeah, that's a good one. That's a good one.
So it's just
Twizzler. I think it's taken already. Twizzler.
Yeah, you want it's good to have the competition that forces you to be better, and it forces you to get creative as well. You want more players in the space, without a doubt.
That's right. And the other thing too that you mentioned, so we talked about the democratization of this. I think your fund is also doing something that's very good in terms of two major components that you see when we're talking about syndication and large investment. One of them is diversification, and the other one is liquidity. So that so tell us about that. How an investor that would go on DiversyFund on your platform, they see the information that's there, and then they decide, they say, yes, I want to invest in DiversyFund. What's the process? And then how are they improving in terms of liquidity, and how are they improving in terms of diversification of their real estate investment portfolio?
Yeah, it's a pretty simple process. You go on a platform, you go through your computer, you go through your cell phone. We have apps. The apps are on Android and iOS right now. It's a very seamless process where you clicking buttons and automatically connects to your bank accounts, and it's very easy to transact. So we make that ability to transact very easy for the consumer. Always getting feedback and improving that again and again. And so typically the funds that we have had set up, they're value add funds, which is the first few years with those assets, you're improving those assets, and you optimize cash flow, usually between a 2 and 3 year time period. And then the cash flows outweigh the expenses, right? And then whatever's left over gets distributed to the people in the fund itself. So typically 2 to 3 years, usually time period to get to that level where your distributions, actually cash dividends paid to the parties in the fund.
Yeah. So I put my $500 in your fund. Do I get to pick specific projects, or I'm just totally in the fund, and then you have some projects that are in year 4 of the value add? You have some other projects that may be getting started in terms of the the investment, like you just acquired it and now you're just about to start the project. Is that how it works? Like you basically are buying into multiple projects, or you're just buying into the new project that gets started?
Yeah, great question. So we got a little bit more mature, so it's a little bit easier to explain now than a few years ago. So pretty much is the first stage is really is aggregating the funds, is getting the funds in, and then as soon as we get them in, we deploy them and buy the assets. So really, it's the fund usually within first 6 to 12 months fills up, and then it just shuts down, and then we kind of create another one. And the process is we go out and we try to stick 10 to 15 assets in each fund. For diversification, we're chasing markets. We're our company is headquarters in California, but most of our properties are North Carolina, South Carolina, Florida, Texas, New Mexico, Utah. Yeah, I think there's one in California now. That's about it. It's tough out here, by the way. If people don't know,
it is tough.
Southeast, we're I'd say probably 75% in the Southeast United States right now, and yeah, and so we just continue to chase yield, chase great deals throughout the U.S. And typically how it works is you put your money in, and at the same time we have like thousands of investors coming on a monthly basis. So you aggregate all those funds, and we have more velocity and more speed of that money coming in, so you're able to deploy a little bit more quicker and get that money working right away.
Oh, okay. So basically, every project that you would have, it'd be kind of like a separate little fund that you would have, and then you would, and then people would just fund that. You have a lot of people. I think you mentioned you had over like 30,000 like people that are subscribers that are current investors, and then they would just jump in there with their money and say, okay, I'm ready to buy another $500 or $500,000, and then let's go.
Yeah, so each fund usually has 10 to 15 properties in it. I guess the best way to say it is the way it's set up and the way all the regulations are, it's to do it on a property basis is not economically feasible right now for this type of offering, due to the third-party fees that are charged through legal, through the transaction fees and the third-party compliance parties. So when you do that and you have that average across a larger fund, it's very minimal effect upon someone's return to that. So if you did a per property basis and you got, let's just say, for instance, you got like $100,000 legal bill for that, really eats away of the return to that. So those are some of the things that we're improving with time, is how we could drop those costs down. Unfortunately, we still kind of live in the legacy world. If you've seen a closing statement on a multifamily project, you can see the attorney fees and the escrow fees are quite high. Shockingly, that business is still very high in cost, and it hasn't trickled down into any kind of tech yet where they're minimizing those costs. It will happen. It will happen across the board eventually, but there's still high fees involved with working with the attorneys and third-party regulatory agencies that you have to deal with.
Yeah, a couple of weeks ago, speaking of just title, just an open and close bracket here, I spoke with a guy, an investor, Marius Skonichny, and he was talking about a company in Canada that was deploying here, and it's going to solve really that title issue that you're talking about producing these closing documents. So they have a system and process in place that are going to, and they were just approved by Fannie and Freddie Mac as a way. It's basically a lawyer's letter describing that, a legal letter that says, yeah, the titles are free and clear, and it's significantly cheaper than the approach that we're currently taking with title and title insurance. Just so that you know, so a couple of so that should have been, that's going to be published like a couple of episodes earlier than this one. So if you want to look at that one, it's pretty interesting. So that's very good. So going back to DiversyFund, I think this is this is very good. I mean, as you are investing more and more, is figuring out also kind of like how to be as slim as you can. I know you're using a lot of technology in order to really make it to bring it to a level where somebody that has only $500 can invest, and it still makes sense for DiversyFund to have that investor. So that's, you need to use technology for that. You need to automate a lot of things. So that's part of the problem, right? Because one of the things that you're doing also is you're also, if I heard right, you're also distributing cash flow to your investors on a monthly basis when it gets into that stage. Is that correct?
Yeah, quarterly once we get that
quarterly.
stage.
Okay.
Again, yeah, mechanics. Love to see if we could make it more efficient. Still dealing with some, I call them legacy worlds in the way those things are being done, and some of the assets that we purchased, they're still a little bit behind the technology. It's just not us. It's as a company, we could build out as much tech as we want, but the other parties, they're still traditional. When you're buying this asset and you're buying distressed asset and you're buying a certain part of the US and you're going in and you're going and getting these like Excel sheets and everything's like, whoa, it's just like, it's really tough to add tech, but it's creeping down to all levels. So those efficiencies will be developed over time. And so we can make those things more efficient and maybe make the distributions more in real time. There's still a large human element involved into this asset class, and we'll see changes. It's slowly happening across the board in every area.
Yeah. So what happens in terms of liquidity? If I'm an investor and all of a sudden I need my funds back, is there a component of liquidity where I can contact you and say, something happened, I want to move, I want to have my funds back? Is there a mechanism for that?
Yeah, liquidity. I mean, these are closed funds. So these funds right today, there's really not that big of a liquidity option. Of course, there's always circumstances for that. We really like to lead with education. It's a growth investment. It's not spec investment. It's a growth investment. It's not income investment. So teaching people what that is and educating them. Since our limits are so low, you really have to look at your specific situation in life. What is it? So I would err on the side of caution and do a little bit less if you perceive something down the road where you might have to liquefy yourself, because you really don't want to touch your growth investments at all. You don't want to do it. Even like if you're in stocks and bonds and there's a crash in the market or something and you need liquidity and you're cashing that out, you're just going to take a huge hit. If you look at it from that point of view, this is something that you're trying to build wealth, and in some cases generational wealth. You got to kind of go into this like, hey, I can't touch this. This is an account I'm putting away. I mean, all of us have funds, not all of us, but a lot of people have funds for their kids. At the end of the day, you're not going to go in there. You're going to make your ends meet. And so you kind of have to treat that the same way. And I would just say, look at your specific situation in life. What does that look like? And since, we're allowing you to come in for a little bit less amount, just look at your situation and make sure you're going in and understanding that investment and where you are today and where you believe you will be in the future. Yeah.
So the idea is really think of it as a long-term investment. Think of it as something that, okay, well, I'm going to put something away for the long term, and I'm just going to get some cash back on a quarterly basis. And then I'll take it from there. But it's just like layer by layer, and then you have some money back. Then you put some more in the next fund, and you put some more, and eventually you may actually have enough cash flowing back to you every quarter to basically maybe retire, maybe travel a little bit more, and leave something for your children.
Yeah, exactly. And again, look at your personal circumstances, but you think most of these funds are 4 to 6 years turnover time period. And always you want to look at the markets too. Today we're in a frothy market. It's a good time to exit. If you started a fund 5 years ago, you're probably kicking ass because everything's great right now. And when you get in, you want to hit the cycle right too. You don't want to be liquefying these funds in a down market. You want to be an up market to really to get that extra return on them. So also you have to endure these down cycles and make sure you're selling at an up cycle and an uptick with it. Right now we have had such a fantastic uptick. Let's not spoil ourselves too much. It's a once in a lifetime opportunity. Anyone who buy anything in the last 2 years is definitely benefiting. Just had a conversation this morning and someone's like, yeah, I bought a house like 3 years ago and it's worth this. And our conversation was like, well, if you sell it, where are you going to go? Because everything's really high. So where are you going to move outside, at least in California, where are you can go and buy another house on top of the market, or are you going to move somewhere else? So you gotta look
to Vegas.
I don't know about the Vegas markets right now, but
also pretty hot. We looked at Austin as well, and it was pretty hot too.
Austin's hot. Austin's been hot. Yeah, Austin's a fun city. It's a great city.
But we digress. So Craig, anything else you want to add about that we haven't touched about? I think we covered quite a bit about the DiversyFund and the reason why you created it, and really democratizing real estate, bringing it to the regular investor with an investment as little as $500. And anything else that you want to add as we wrap up this episode?
I just think everyone needs to start their journey, get involved in the private markets, and every single person who does not have a flat screen TV. And what does a flat screen TV cost you? Like at least $1,000. So what's your excuse? It's a $500 minimum to get started. Take it as an education. At the end of the day, you're educating yourself. How many online courses are you wasting money on? How many dinners do you spend $500 on? How many if you buy something or whatever that is? You could start your journey, start your personalized journey, learn about it. Try our platform. If not, try another platform out there. Educate yourself. Learn about this. The more people do it, the more of us, companies such as ours, will pop up, be successful. And the more of us being successful, more people will be successful on their journey.
Yeah. Craig, thank you very much. Thank you for helping all these investors with their long-term investment, long-term goal, and hopefully achieve financial freedom. So thank you very much.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.